Good morning and welcome to the Killik and Co Market Update. This week, the US Senate has voted to raise the debt ceiling in the US, which has come as a relief to US stock markets. The debt ceiling is the maximum amount that the US government is allowed to borrow, and it had been due to run out of money in about 2 weeks' time. And this would have had several knock-on effects on the US economy. In the short term, federal employees would not have been paid, benefits would not have been paid to US citizens, and in the longer term, the government would have defaulted on the interest payments on existing borrowings, and that would have damaged the creditworthiness of the US, and that would have made it more expensive to borrow, therefore compounding the problem. As you can see by this chart, which goes all the way back to 1993, US national debt has risen considerably in recent years, particularly due to the borrowings during the pandemic, and at the moment the level of US national debt is over $28 trillion. The debt ceiling has been raised over 100 times since it was first introduced in the 1930s, but nevertheless markets were quite jittery as this current deadline approached, and as you can see by this chart, the S&P 500 has picked up since the Senate vote went through this week. However, the current vote was only about raising the debt ceiling until December this year, so it's really a very short-term solution, and a longer-term solution will be needed if Joe Biden is to embark upon his multi-trillion-dollar planned infrastructure spend. The oil price has gone above $80 per barrel over the last week, and we've also seen the share prices of oil companies rising as well. Demand for oil has gone up over the course of the last few months as the global economy has reopened, and more recently we've also seen oil being used to produce electricity because of this natural gas shortage. Here's a chart showing the change in the oil price over the last 10 years in comparison to the change in the Royal Dutch Shell share price over the last 10 years. So you can see that they move roughly according to the same pattern. Over the last 10 years, Royal Dutch Shell shares have definitely come down, but they have more than doubled since the lows of the pandemic. So it's probably worth looking at portfolios and just thinking about how much you currently have invested in the oil sector. Just back to that shortage in natural gas, we have seen the price coming down a little bit over the last week, following some comments by Russia about supplying more gas to Europe. Europe currently gets about 40% of its gas from Russia, and actually a large part of the shortage we're seeing at the moment has been due to a reduction in supply from Russia. So that really shows how dependent Europe is on President Putin. The UK gets very little of its gas directly from Russia, but nevertheless it is impacted by the shortage in Europe. And it therefore makes sense that the UK government is looking at new nuclear power stations, new wind farm generation capacity in order to achieve energy independence. And finally, we've been looking at some data this week which highlights the sad decline of London's stock market. Historically, London has been a very attractive destination for global companies to list on, and back in 2006, about 10.4% of global market capitalization was listed in London. However, that figure has now fallen to just 3.6%. No major technology companies are currently listed in London. The biggest company in the FTSE is actually AstraZeneca, which is worth about £137 billion, and that pales in comparison to something like Apple, which is worth well over $2 trillion. So it is a sad situation, but it's a helpful reminder that it's really important to look outside of the UK when investing. Moving on to have a look at next week, we are expecting results out from luxury goods company LVMH, JP Morgan and Rio Tinto. That's it from us. Enjoy the weekend, and we'll see you next Friday.